This week's market meltdown was no technical crash. It was a sudden realisation that the economies of the US and Europe were broken and no one knows how to fix them. Neil Woolrich takes a look at how things unravelled and what may follow.
Raising of the debt ceiling has been unsettling.
To give you a reality check, here is the size of the US debt at this minute.
To be frank, almost everything else about this deal stinks.
Investors have basically said, you can keep the cheese, let me out of the trap.
It wasn't supposed to be like this. Once Washington finally resolved its debt impasse, markets were expected to rally. Instead, it's been a rout.
What's really happened over the last 24, 48 hours is global growth concerns have taken over as the driver of risk assets. And as a result, we've seen equities throughout the world fall. We've also seen the Aussie dollar, which is classic canary down the coal mine growth indicator, take a big tumble.
What is very plausible is a prolonged period of very weak growth. So it might be positive. I mean, my expectation is that we'll continue to have positive growth, but it'll just be very, very weak, and it could very well be accompanied by continued rises in the unemployment rate and very, very little job creation and possibly even job loss.
The data from the US this week only gave the pessimists more ammunition. It showed continuing weakness in manufacturing, a reduction in consumer spending for the first time in 2 years, and an unemployment rate stuck above 9%. Late on Friday in the US, Standard & Poor's rubbed more salt into the wounded economy, downgrading America's credit rating for the first time in modern history.
The risks of developed world recession next year are growing by the day, and what the market's doing actually increases the risk. And my view is, if that's what unfolds, and I'd put it as a 50-50 chance, there is, in my view, a lot more downside in global equity markets.
The markets are overly pessimistic. I think what we're going to see at the moment is a mini GFC, if you like, where markets priced in a Great Depression, which never eventuated. I think we're seeing a small rerun of the same process where markets are pricing in a global risk of recession, which just isn't going to eventuate.
And not even the 11th hour deal to lift the debt ceiling gave much relief.
With just hours to spare, America has avoided the national humiliation of not being able to pay its bills.
Make no mistake, this is a change in behavior. From spend, 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 to cut, cut, cut.
But some economists worry the promise to cut back government spending comes just when the US economy most needs a boost.
Well, the recovery is very, very weak, and this is the big tragedy, or at least to my mind, the biggest tragedy of this whole debate, that we had Congress and the President tied up literally for months yelling at each other about the debt ceiling, which really doesn't mean anything. I mean, you have to do it, but I mean, it's sort of like taking out the garbage.
Dean Baker argues the United States debt problems were overstated by politicians, and what they should have been focused on was growth, or the lack of it.
There's no sector of the U.S. economy that has any great dynamism to it. Housing, construction in general is going to be depressed for the foreseeable future because we had so much overbuilding. Consumption, people are still adjusting to the loss of trillions of dollars in housing bubble wealth. The foreign sector is not going to do very well because many of our trading partners, certainly Europe, is in a bad slump.
The Europeans, though, do have genuine debt concerns. While Greece's crisis appears to be under some sort of control, it's the bigger economies that investors are now worried about.
So we're now seeing new stress coming on to much more important economies such as Spain and Italy. And once again, that involves feedback loops. These are countries that are arguably solvent if the market prices them as solvent, in other words, charges them a low interest rate. But if the market prices them as insolvent, that is, pushes up their interest rate, they become insolvent.
Those economies are growing reasonably. They're not spectacular, but they are growing reasonably. A lot of the US data that everyone's been so pessimistic about was in fact still expansionary economic data.
While other parts of the developed world are staring at recession, here in Australia it's a different story. The Reserve Bank is forecasting GDP growth of 3.25% by December and 4.5% in 2012. Although that's slightly lower than previous estimates, the Reserve Bank's outlook is seen as optimistic, especially given this week's developments.
But actually the bigger worry to me is that we now have policy in Australia very restrictive on a number of fronts. Monetary policy is restrictive, We're about to embark on a quite significant tightening of fiscal policy. The currency is clearly sucking the oxygen out of the traded goods sectors.
Australia is the great underperformer of Asia, and it has been for a few years now. And we really need to lift our game, and the only way to do that is through productivity, and the only way to achieve productivity gains is fresh capital investment. We've really got to lower our tax system quite significantly if we're going to get those sort of productivity gains that we really need going forward.
However, despite this week's sell-off, Clifford Bennett remains optimistic about long-term prospects for global markets.
We're advising short-term investors to be cautious and take a little bit of a wait-and-see approach, but certainly long-term investors have got to be gently accumulating each day at this point. You never know when you're going to see the low in the market. I don't think we've seen it yet. I think we probably will get just a little bit lower.
And that's about as upbeat as anyone these days, so it looks like some time yet before buyers come rushing back to the market.